Hi there. Welcome to Berman's Call. We are here to take your questions on both stocks and ETFs today. You can reach us toll free at 1-855-326-6266, or you can email us at bermanscall@bnnbloomberg.ca. And Larry joins us now, of course, to kick off today's episode. Larry, it's great to see you. I guess we'll talk first of all about, geopolitical issues that have been happening and how a lot of investors tend to focus on geopolitics. Do you think that's valid, that investors are concerned about what's happening around the world, particularly what's happening with Iran right now?
Oh, it's absolutely valid. It depends on your time frame as an investor. For me, we're very tactical. So these events that cause dislocation in markets matter a lot. In the long run, the markets are driven by earnings and ultimately, global economic growth. And so to the extent that a geopolitical event is going to disrupt earnings momentum and global growth, it matters a lot. Should most people be trading that? No. But if you're sitting on the screens and that's all you do, then absolutely, there's opportunities to develop. For the average investor that sits at home and looks at their statements once a month, you shouldn't be overly worried about it. You should have portfolios set to deliver the expectations that you're looking for the next 5 or 10 years, not the next 5 or 10 hours.
And so you think the focus now is shifting back toward growth and earnings. Is that correct?
Well, yeah. I mean, the S&P 500 made a new all-time high last week. We saw the NASDAQ up 13 days in a row. Haven't seen that in many, many years. So clearly, we're back into a risk-on environment, and we are entering the meat of earnings season, where in the next couple of weeks, we are seeing 50% of the S&P 500 companies report, including coming up very soon most of the Mag 7 stocks. And it's going to matter a lot what these stocks have to say about AI spend, CapEx, inflation pressures, cost pressures, business growth, et cetera.
Because there was a time when, the Mag 7 were really driving the markets, and that's just doesn't feel as though that's the case at the moment. You think that might be more of the case moving forward rather than what's happening geopolitically?
So always earnings matter. The Mag 7 that have been driving growth. In recent weeks, we did a breakdown of where the earnings growth is coming from, and it's still very much concentrated in technology and healthcare over the next year. So there's still a bifurcated market in that sense. But a lot of those Mag 7 stocks got fully priced. And, the market's just got to take time to catch up to those lofty earnings expectations. I have no doubt that we will, but a lot of these stocks can go sideways, for a year or two.
For sure. Okay. We're going to take a quick break right now. Coming up, though, we'll get to your phone calls and your emails. Here's the number again. There's still time to give us a call with your questions on ETFs and large cap stocks. You can call us 1-855-326-6266, or you can email us bermanscall@bnnbloomberg.ca. We'll be back in a moment. Welcome back to Berman's Call. We are here with Larry Berman answering your questions now. Larry, we'll start with an email question. This one coming in from Wade, and it reads, I have held Petrobras for many years and have enjoyed the USD dividends and gains, but I think it is time to take profits. What can you recommend I replace it with that has high USD dividends?
So it seems like this investor needs to stay in US dollars and isn't overly concerned, and they need, I guess, a U.S. regular cash flow. Petrobras, I believe it is time to trim. We really liked it in, close to 10 in the last few years. But for us, we were out of it by 15, so missed the last big rally here. This is, when you're talking about replacing a single stock with a broadly diversified exposure to ETFs, and it really depends on how high yield and how tax efficient you want to be. But some of the Canadian listed ETFs that do covered calls and dividend-focused stocks in the U.S. that have tax efficiency have U.S. dollar units. And one of the ETFs that I really like for that is ZPay in U.S. dollars. So I would look at that. It's got a nice dividend. It's got lower risk than the average market. It's got good growth potential, and that it would be much more diversified than holding and relying on a single name like Petrobras.
Okay. We've got another email question, this one from Jewel, and it says, I would like to know Berman's opinions on PayPal and Block Future, please. Block XYZ Future. Larry, what do you think?
Yeah, so, PayPal is a name that, it's in a bit of a value trap. I've liked the name. I started liking this name in the $60 range, and it went a lot lower than that. And so, I think at best case, this thing recovers and maybe you see it at 60 or 65, maybe 70, best case. So there's some upside potential, but there's probably a lot better names to own in the tech space. There's a lot of disruption coming to software services, cash processors, kind of like PayPal. I'm not an expert in the space, and I don't know who's going to be the ultimate winner here to sort of recommend an alternative at this point.
I take your point that, you maybe don't know who the winner is going to be, but you say there's better names to own in the tech space. Which ones are you kind of looking at or that pique your interest at the moment?
Well, so on the ETF side, software as a service, overall ETFs, IGV. And I've talked about that in recent weeks here where that got really obliterated in the last year. And I've been accumulating that name. So I think there's a lot of value in there in the whole software sector. PayPal's not one of them. They're really an electronic money processor. I don't know of an ETF that plays specifically in that space to get some diversification, within the group of stocks.
Okay, got it. All right, we're going to go to the phone lines now. Sam is calling in from Brampton with a question. Hi, Sam.
Hi, Lindsay. Hi, Larry. Thank you for taking my call. Larry, my question is on ZEB. I bought ZEB way back in around $28, $29 range. Now it's trading somewhere in the $65 range. Would you start taking your profits now, or would you just add more to it at this price? What would you do? But these are all in registered account. I'm trying to build my retirement fund. Thank you, and I'll hang up and listen to your.
Okay, thanks, Sam, for that question. Larry, what would you do in this situation?
Yeah, listen, you can't go wrong betting on the equal weight Canadian Bank Index. It's been an excellent performer for decades. Great dividends, great coverage, well-regulated institutions. So, love it, love it, love it. I don't love it, but for the most part, I've been saying this, for the last 6 months. And we've had some ups and downs in those 6 months period. If you just threw your line back on the charts in November, we're up from there with some volatility. But when we do get an economic slowdown, the banks are going to get hit the hardest in Canada in particular. So when is that going to be? So the answer is I don't know, but it's something that I certainly wouldn't be adding new dollars to at this point. I don't see a reason to rush out and sell this thing on a pure valuation standpoint. It could clearly grind a little bit higher, but adding new money here to me doesn't make sense. Buying Canadian banks on corrections and pullbacks is the way to play it for most Canadians.
So hold off for now. All right. We're going to go back to the phone lines. Joe is calling in from Oakville, Ontario with a question. Hi, Joe.
Hi, how are you?
We're great. How are you doing?
I'm great also, thanks. I was just wondering if I can get Mr. Berman's opinion on Vital Infrastructure Real Estate Trusts.
Okay, thanks, Joe. Larry, what do you think? Vital Infrastructure?
Well, so you kind of have to define what vital infrastructure is. In some definitions, it's semiconductors. In others, it's broader building. So I don't know the name that well here. And I would have to do a lot more work on it to really give a strong recommendation. Clearly, it's been performing pretty well over the last year, but I don't know enough about the details on exactly what vital infrastructure is in this asset to really give a lot of value added here.
Okay, we'll move on to the next caller then. Henry calling in from Ottawa with a question. Hi, Henry.
Hi, I want to ask Larry about gold ETFs. I'm a senior. I have less than 1% of my portfolio in gold. It's in a CI, a giant covered gold leaders ETF. And I'm overweight in financials. I want to take some of my profits and I want to put more into gold. I wanted to ask Larry's opinion about that, and if he could think that I should add on, what ETF would he recommend? Thank you.
Okay, thanks for that question. So I guess, Larry, we'll start. Any gold ETFs that you would recommend?
There's many of them, different ways to play it, Canadian, US dollars. Some have covered call overlays. It really depends. And so these very specific questions that are unique to individuals, without knowing a lot more detail on their financial needs, their income needs, their tax issues, it's very, very hard to say this one's better than that one. I like the idea. I think gold probably, as a general sector, we see gold pull back to 4,000 before we go to 6,000. But I'm pretty sure gold is going to continue to rise in the world we live in today. I just think it's peaked for now. And so on a correction, it makes more sense than to do it right now. If the money is coming from an overweight position in Canadian financials, I'm okay with that trade on a relative basis. And if you're looking at Canadian banks with a covered call, I would look at gold equities with a covered call. And there's a couple of them to choose from in Canada.
Any that you particularly like?
Again, you're kind of putting me on the spot instead of saying one's better than the other. They're both, they're well managed. Mm-hmm. Either one is fine. It's really going to depend on the individual's kind of specific needs.
All right, we're going to move on. James is calling in from Toronto with a question for Larry. Hi, James.
A general question on ETFs, on alternative ETFs. If you take the returns from the alternative ETF and reinvest them, would you be further ahead than a regular ETF? That's my question.
Okay, thanks for your question. Larry, did you catch that one?
Yeah, I think so. But when you define alternatives, you could mean alternative, meaning ones with derivatives like covered call ETFs. You could mean alternatives as in real asset and infrastructure, because those are often considered alternative holdings, real estate in particular. So it's not clear from the question about reinvestment. Generally speaking, a distribution is taxable in the year that it's paid. So is it a registered account or a taxable account? Again, it's a good question, and it's hard to know that there's a clear answer that you would be better off. One thing that reinvesting and compounding your returns free in a tax-efficient manner, that I can tell you in the long run is much better off, not taking the distribution and deferring it and getting some sort of long-term capital gain treatment. So without knowing more specifics, I would say you're definitely thinking in the right direction, but I'm not sure I can answer that specific question.
Okay, we've got Andreas now calling in from Calgary with a question. Hi there, what's your question?
Hello to you, Larry, and thank you for taking my call. I wanted to know about Nike shoes, NKE. I know the stock is down quite substantially from what it used to be. Is it reflecting a lot of trouble for them, or would it be a buy at some point going forward? I'm just going to hang up and listen to what you have to say. Thank you so much.
Okay, thanks, Andreas.
Yeah, they've got several levels of trouble at Nike. So it's a name we added recently to our portfolio, around $45. I'm not looking for it to hit home runs here, potential for it to get back to mid to upper 50s is realistic. So for us, it's a bit of a trade. When you look at forward-based earnings expectation, stock is still very expensive at 30 times forward earnings. So unless they really turn it around, unless they can figure out the China headwind, this Nike's going to struggle, and so every time it rallies, it likely rallies to a lower high, and every time it sells off, it likely goes down to a lower low until valuations come back down to a more mature clothing company as opposed to the growth story it's been for decades. And that's how I'm characterizing Nike right now. So we're long for a trade, but we're not long for an investment.
Okay, we've got Kelly calling in from Ponoka, Alberta with a question. Hi, Kelly.
Hi, I was just wondering what your thoughts are on HPYB and HPYE. And I'll just hang up and listen to your answer.
Okay, thanks so much for that question. Okay, HPYB to start. Larry, what do you think about this ETF?
Yeah, so Canadian banks, covered call overlays, any of these strategies that are related to getting premium income, I like a lot for people who need more income in their portfolio. One of the caveats for all of them, and it doesn't matter who's really doing them, is that if you're really, really bullish on the underlying, you're giving up your total return growth in the very long run. If you're looking for tax efficient current income on them, then they all generally achieve that goal. So you have to look at them and whether they're writing and overwriting and using leverage to define what your path of returns is likely to be on which one is most appropriate for you. Harvest is a good firm. They really execute well. Some of the ETFs tend to use a little bit of leverage. So I'd be just a bit mindful of that, if that's the right allocation for you.
All right, now we're going to move to an email question coming in from Julia, and it reads, thoughts on Celestica. It reached an all-time high in the 500s. Is now a good time to sell? Is there much more growth? It holds a large portion in my portfolio. So price targets recently raised on Celestica. Larry, what do you think about this company?
This is a name that, was a darling 25, 30 years ago in the growth phase. The stock isn't trading cheap here. Maybe if you could do a 5 or 10 year picture for perspective, that would be interesting because, here's a name that went from, it's a triple in the last year. I'm a value investor. And so you're asking me a question about, a growth story and a multiple that I can't explain or understand. Again, you see where it's come from here. So this is one that I would say, listen, we got to avoid this. Definitely for momentum type traders. And that's really the story here. So I wouldn't be an investor at this point. And I would need to really understand why it's trading where it is. I can't imagine just the whole idea of powering artificial intelligence is driving this, but there's some thematics out there that are experiencing these kind of stories right now in multiples.
All right, we're going to take a quick break right now. We'll be back with Larry in just a moment because coming up is today's educational segment with Larry Berman. That's right after this. Stay with us.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. We are here with Larry Berman, and it's time now for Larry's educational segment. Larry, the question today, should you be a long-term bull on oil and gas or a tactical trader? Take it away.
Yeah, the catalyst for this question, I was actually stopped on the street here in Fort Lauderdale last week by a Canadian. And they were asking me about oil and gas and my thoughts here. So I did a bit of a deep dive on the weekend looking at the forward curves and what the market message was telling me. And I've got a very interesting chart to share with everybody just for the idea of thinking about what we're looking at here. So the white line is the current, as of earlier this morning, price of the futures curve. So as we go out in time there, what you're seeing is basically a 10-year forecast in terms of what the futures are pricing in. So that's the white line, and that's current. You can see that price in 2037 is around $53 a barrel compared to the current prices that are in the $90 plus barrel range, or 80 high 80s at this point, notwithstanding the move overnight. The red line there, if you can see the red line on the chart, that's what the futures curve was 1 year ago. So 1 year ago, the U.S. didn't have regime change in Venezuela. Venezuela is a big oil producer, and obviously they had not yet attacked the war. So that's actually the futures curve as Donald Trump was elected. So if you look at the purple line here, so when Donald Trump was elected, he drill, baby, drill. We're going to be the best producer of oil in the world. And you can look at kind of what happened in that environment to the in the purple line here in terms of, historical prices went up a little bit from what they were, but sorry, not significantly. So that purple line is November 2024 on election eve. The red line is 1 year ago. So drill, baby, drill. Oil prices come down a little bit, more supply coming. That's what the message of the market was. A month ago, before the war in Iraq, you had the blue curve, or a month and a half ago now. The blue curve on February 27th, what had happened there after the invasion in Iraq is longer term prices, see the blue line going below the red line, started to say that forward looking, there's going to be more friendly supply to the world because Venezuela was going to become a real producer again, as opposed to the broken down infrastructure that we know is there today. And it'll just take 5 years for us to get that world production going. And then, of course, with the war. So currently, prices are elevated, but not in a material way when we look past the next year or so. And this is why I say we've got to focus on what December oil does. And if December oil breaks below 70, we're past this. If it breaks above 80, we start to have to worry about long-term inflation. And at that point, equities will care a lot more. Everything else is noise at this point.
Okay, we'll have to leave it there. Larry, thanks for that. And if you'd like to follow Larry online, you've got options from YouTube to LinkedIn. That's it for today's show. Join us for Berman's Call Mondays at 3 p.m. Eastern, 12 noon Pacific. And if you've got a question about a specific stock or ETF, you can email us anytime at bermanscall@bnnbloomberg.ca. And remember to include where you live in the email. Thanks so much for watching.